The San Francisco Bay Area housing market has staged a rebound from recent lows due to an uptick in demand from a dip in mortgage rates and a rise in the stock market. In today's video, we're going to look at which regions of the Bay Area contributed to the recent strength and assess the factors that contributed to it and whether or not we could see the region's home prices continue to head higher. If you're new to the channel, my name is Eric and I am a licensed real estate agent in the state of California, in addition to being a professional economist. So I can bring you insights into the housing market and the overall economy that you'll be hard-pressed to find on other YouTube channels. Let's not waste any time, get straight into it. The median home price for an existing home in the Bay Area came in at $1,229,000 in July. The most recent data from the California Association of Realtors, which I have seasonally adjusted. While this is still down 12% from the peak of about 1.4 million in April 2022, it is up 9.6% from the recent low point of 1,122,000 in February. To get a better sense of which part of the Bay Area the recent strength is coming from, let's take a look at the median price for the region's different metropolitan areas. Here are the counties in the North Bay. We're seeing decent price performance in Napa, Marin, and Sonoma counties, which have rebounded by 3.5%, 5.6%, and 6% respectively. Solano County came in the strongest in the North Bay with an increase of 8.1% from the recent low. All good numbers, but fall short of the 9.6% we're seeing for the region overall. Here are the metropolitan areas in the East Bay, which includes Alameda and Contra Costa County, the San Francisco Peninsula, which includes San Francisco and San Mateo counties, and the South Bay, which includes Santa Clara County and San Benito County. The East Bay saw a small 1.9% rebound from recent lows, and the Peninsula didn't see much of any rebound in prices lately. Neither of these contributed to the overall Bay Area rebound. Now we come to the source of the recent price strength, the South Bay. Since the low point back in February, the South Bay median price has increased by 12.2%, notably higher than the 9.6% for the region overall. So the South Bay was the biggest contributor to price growth we're seeing in the Bay Area, and this is due to a perfect storm of factors that led to a boost in demand. You can see here that just before the rise in prices, we saw mortgage rates pulling back from their surge of the preceding year. People had started to become accustomed to higher mortgage rates as part of their financial decision to buy a home, and the drop from 7% to 6% presented an opportunity to take advantage of. For most of the time prices were rising, mortgage rates were below 6.5% for the most part. Now, you might be thinking mortgage rates were down for all regions. Why do we see the biggest price gains in the South Bay specifically? That brings us to the next factor in our perfect storm, the stock market. You see, the South Bay is home to Silicon Valley, the largest hub for technology companies in the United States, if not the world. Here's a chart of the 30-year fixed-rate mortgage and the tech-heavy NASDAQ stock market index. Notice that at the same time mortgage rates were pulling back and staying below 6.5%, the NASDAQ was rebounding from the downturn in 2022. This would have provided a boost in equity for those tech workers that get stock as part of their compensation and have been on the sidelines waiting to buy a home. So we had a drop in mortgage rates at the same time the NASDAQ stock index was rebounding from a major downturn. It was a perfect storm of factors that led to a boost in South Bay housing demand due to an increase in affordability and income, which was big enough that it contributed to a sizable increase in the median price in the Bay Area overall. Now, the next question is whether or not we will see this recent strength in demand continue or if it was short-lived. First, for mortgage rates, we are already seeing them rise again as the Federal Reserve has continued to raise their Fed funds rate and has signaled that more rate increases are to come to battle inflation. So we're not going to see any more relief in mortgage rates anytime soon. They are more likely to increase rather than decrease in the months ahead. For the stock market, we've seen a pause in the market rally that began in the beginning of the year, as there has been much talk of a potential recession as a result of the Federal Reserve's explicit actions to slow the economy. I recently released a video looking at the potential risks to the U.S. economy on my other channel, PapayaCast, so check it out if you want my latest analysis on the U.S. economy and whether we're headed for a recession in the immediate term. The bottom line is that we are unlikely to see a recession before the first half of 2024, so there could be a bit more breathing room for the stock market rally to continue. Overall, however, because of the rise in mortgage rates and the prospect of further increases, we are unlikely to see Bay Area prices continue to rise as they have in the first half of 2023. In places like the South Bay, where incomes are more tied to the stock market, we could see better price performance relative to other parts of the Bay Area, but nothing in the form of another housing boom where new price records are being set each month. If you liked today's video, I hope you will consider subscribing to the channel and hit that notification bell down below so you know right away when my next housing market analysis video comes out. And don't forget to hit the like button to support the channel and help it grow. Thanks for stopping by, and I'll see you in the next video.